Welcome to this video on activity ratios. A business possesses a lot of different types of assets, isn't it? These assets the businesses are using in order to make a profit. So, activity ratios, like all other different types of ratios, are used for financial planning and forecasting by businesses and its stakeholders. So, let's start activity ratios. What are activity ratios? These are the ratios that gives us light on how efficiently and in what speed and with how much of speed the assets or the resources of a business concern are being managed. These are calculated on the basis of net sales or cost of goods sold. They are expressed in number of times. For example, the inventory turnover ratio is expressed as, suppose, say, if it is 3, you write it as 3 times. The debtors turnover ratio is 4 times, like that. Where the entity is good, this particular ratio shows us where a particular entity is growing towards, whether it is growing, whether it is declining, and for that the ratios have to be compared with the past data of the same company. For example, if stock turnover is being computed, a particular company's stock turnover ratio, in order to see what is a trend or where it is going, whether the inventory is efficiently utilized or not, it has to be compared with the past year's figures or that of the industry standards, etc., in order to see whether it is growing or whether it is in the decline stage. Now, these ratios are also known as mixed ratios, composite ratios, or interstatement ratios. Why? Because in order to compute activity ratios, we take the accounting figures that are disclosed in both the income statement as well as the position statement. Both information provided in the profit and loss account as well as the balance sheet is being utilized in order to compute these ratios. Hence, they are also known as interstatement ratios. Now, the other names for activity ratios are turnover ratios, turnover ratio. It can be called asset management ratio, asset management ratio, and it is also known as performance ratio. Let's move on and see the different types of turnover ratios. These are the different types of turnover ratios. We have inventory turnover, debtors turnover, creditors turnover, working capital turnover, fixed assets turnover, net assets turnover, and total assets turnover ratio. The first type of the ratio is the inventory turnover ratio, also known as stock velocity. Stock velocity. It establishes the relationship between the cost of goods sold and the average inventory. And what is the significance of computing this particular ratio is it shows the number of times the inventory is being turned over in relation to the sales that are being made. How do we compute the ratio? It is by dividing cost of goods sold by average inventory. Cost of goods sold figure is not given, you can take the net sales figure. Average inventory you compute by adding the opening and closing inventory and then dividing it by 2. If this inventory figures are usually taken at cost, if at cost figures are unavailable, we can take the selling price based inventory value. Now, there is something called inventory conversion period, that is, it shows how quickly, what is the average number of days or months within which the inventory is being converted. It is expressed in days or months or even weeks. And then higher the ratio, it means better is the sales. Then lower inventory turnover ratio might mean overstocking or overvaluation of the inventory. It means here the inventory is efficiently managed, while in case if it is low, it is inefficiently managed. Then overstocking has its own dangers, because when we hold too much inventory, not only will the turnover ratio be low, where there is also the risk of blocking of capital in the inventory, more cost of holding the inventory may become obsolete, and thereby the firm may face a liquidity crisis. Let's do a problem to understand the ratio better. There is opening stock figure given to us, closing stock, the cost of goods sold. We are supposed to calculate the stock turnover ratio. Stock turnover ratio as well as the inventory conversion period. How do we compute stock turnover ratio? Stock turnover ratio is equal to cost of goods sold divided by average inventory. Cost of goods sold is equal to 5 lakh. What is average inventory? 40,000 plus 60,000 divided by 2, that would be 1 lakh by 2, that would be 50,000. And it is 10 times. We need to compute the inventory conversion period. Let's compute it in days. So 365, that is number of days in a year divided by the ratio, is 36.5 days. The inventories are turned over in 36.5 days. See the next question. Stock turnover ratio is 6 times. Average stock is 8,000 and selling price is 25% above cost. So what is this 25%? That is the amount of profit that the business is making. Now stock turnover ratio and average stock is given, we can easily find out the cost of goods sold, isn't it? Stock turnover ratio is equal to cost of goods sold divided by average inventory. Cost of goods sold is equal to stock turnover ratio 6 into average inventory 8,000, 48,000. We are supposed to compute gross profit. What is gross profit? 25% of cost. What is the cost that we got here? 48,000. So 1/4 of 48,000 is 12,000. We easily found out the answer. And the next question. Inventory turnover ratio of a company is 3 times. The cost of goods sold during the year is 2,270,000. With better inventory management, it increased the inventory turnover ratio to 5. How would it affect the inventory? Will it increase the inventory, decrease the inventory? Or if so, by how much? Let's see. Inventory turnover ratio is cost of goods sold divided by average inventory. We are given the ratio, we are given the cost. So what is the average inventory? Cost of goods sold divided by the inventory turnover ratio. 2,70,000 divided by 3, that is 90,000. Now the inventory turnover ratio increases to 5. What will happen to the inventory? That means cost of goods sold remains same, but inventory amount changes. We have to find out what is the value of inventory. So now the inventory turnover ratio is 5. Cost of goods sold is 70,000, 2,70,000. Average inventory. Average inventory is equal to cross multiply 2,70,000 divided by 5, and that would be 54,000. So what happened to the average inventory? 90,000 became 54,000. It decreased by 36,000 rupees. That is the change that happened to the inventory. It decreased by 36,000 rupees when the inventory turnover ratio increased. Next we have the debtors turnover ratio, also known as debtors velocity. It establishes the relationship between net credit sales and average receivables of the year. It shows how liquid the debtors are, how easy it is how easy it is to realize the amount of debtors. Efficiency of the debt collection is what is evaluated by the ratio. The formula to calculate the ratio is net credit sales divided by average trade debtors. Now net credit sales, what do you mean by net credit sales? Simple, total credit sales minus sales return. And how do you find credit sales? From the total sales, deduct cash sales, you get credit sales. Now average trade debtors is the Opening and closing debtors is average. Opening debtors plus closing debtors divided by 2. Now, trade debtors include sundry debtors, bills receivables, and accounts receivables. Now, if opening and closing balances of debtors is not given, and we are not given information as to credit sales, then the formula that we'll be using to calculate the debtors turnover ratio is total sales by debtors. Now, debtors have to be taken at gross value only. That is before providing for bad and doubtful debts. Bad and doubtful debts. And debt collection period, that is also known as average age of debtors. Average age of debtors, that is approximately what is the time taken to collect the amount of debtors. So number of days in a year or number of months in a year divided by the debtors turnover ratio. Now, and what is the purpose of actually calculating these ratios? Simply to find out, as I told you, how liquid our debtors are. The number of times the debtors are turned over in a year in relation to the sales that are being made. Now, while interpreting the ratio, higher ratio or a shorter average collection period means better, liquid are the debtors. It is good. Lower ratio implies an inefficient system of debt collection or lower liquidity of the debtors. The firm's debt collection efficiency is lower. Now, a too high debtors turnover ratio is also not a good sign because it could mean loss of potential sales that a firm does not have or it lacks the necessary resources in order to make credit sales, and thereby it loses sales and thereby profits. So, too high ratio is not good. High ratio is good, but low ratio is also not good. Now, so as to compare the ratio, there is no certain rule of thumb or a standard ratio. No. The firm has to compare the ratio against its own credit terms and policy. Credit policies and terms can also compare the ratio with the industry standards or that of the competitors and see where it stands with respect to the debt collection. Let's do a few problems and understand the ratio well. We have total sales, we have cash sales, we have debtors at the beginning and debtors at the end. So what are we supposed to find? Debtors turnover ratio. Let's see, what are the credit sales? Total sales minus cash sales, that is 2 lakh minus 40,000 is 1 lakh 60,000. We have debtors at the beginning and debtors at the end. So what do we get? We get the average debtors. Average trade debtors 35,000 plus 55,000. 35,000 plus 55,000 divided by 2. You get 45,000. Now we can find the ratio, that is net credit sales divided by average debtors, 1,60,000 divided by 45,000. That would be 3.56 times. The debtors are turned over 3.56 times. We are supposed to calculate the average collection period here. We are given credit sales, debtors and bills receivable. Bills receivable and debtors both come under trade debtors. We are given the total of credit sales. Now to compute average collection period, the formula was days in a year or months in a year divided by the debtors turnover ratio. Debtors turnover ratio is net credit sales divided by average debtors. We are given 60,000. We are not given average debtors, so we will take the given balance. 5,000 plus 5,000, 10,000. That is 6 times. Now, average collection period, let's calculate it in months. So that would be 12 months in a year divided by 6 divided by the ratio. 2 months is the average collection period. Now, one more problem. When debtors turnover ratio is 4, what is the average collection period? Now we know average collection period is equal to, let's say, days in a year, 365 or 12 months in a year divided by the debtors turnover ratio. Now we need to calculate this. Let's take months divided by turnover ratio for 3 months. Let's see. The next type of ratio is creditors or payables turnover ratio. And what is it? It establishes a relationship between the net credit purchases of a business concern and the average payables. Average payables, these payables consist of sundry creditors and bills payables. Okay. Why is this computed? This is also a liquidity indicator. It shows how often, number of times the creditors are turned over in relation to the purchases that the company or the firm makes. Shows how creditworthy a particular business concern is. And this ratio is computed by dividing net credit purchases by average trade creditors. See, net credit purchases, total credit purchases minus the returns. Average trade payables, how will you compute? Opening payables plus closing payables by 2. Average payment period is months or days in a year by creditors turnover ratio. And what is this approximate time taken to this average payment period? That is the approximate time taken to pay back the creditors. Here also creditors are taken at gross value before providing for discount on creditors. That amount is taken into consideration for the calculation of this ratio. So so long as the interpretation is concerned, a high creditors turnover ratio or a shorter payment period means better liquidity position, or it can be or it can mean that there is availability of lower credit, or it can mean that the firm makes early payments. Lower creditors turnover ratio or longer payment period means the firm is less liquid and it avails more credit or it makes delayed payments. Here also there is no particular standard against which or ideal ratio against which you can compare. The comparison has to be made with the companies or the business consensus past data or that with the industry standards in order to make a meaningful interpretation.